My name is Atunkosi, also equity analyst at PSG Wealth. And today we'll discuss the company update following Tesla's second quarter results. I think the key takeaways in the results is that the results were quite strong, came in ahead of expectations. Really driving that was strong pricing in this period. That drove the earnings beat, and then volumes were quite resilient. So we saw shutdowns in China happening in this period. Despite that, they were still resilient in terms of the volumes growth, which was up roughly about 26%. So there's some indication that they're starting to ramp up the Texas and Austin plants. So that supported volume in this period. In terms of the outlook, we still think they're on track to achieving 50% average annual growth per annum. And we value the company on a price to earnings basis. So no changes in terms of the exit multiple. Given the strong pricing and resilient volumes in this period, we increased our earnings for Tesla. So that drove our increase in intrinsic value from roughly $547 to $634. But we still maintain our recommendation, which is a sell. Looking at the event, as mentioned, the volumes were quite strong in this period despite COVID lockdowns in China. So we saw volumes up 26% year on year, despite the sequential decrease on a quarter-to-quarter basis. So delivery at 254,695 vehicles. Group revenue was up 41.6% to 18.8 billion. Operating income improved quite massively from 1.3 to $2.4 billion. And this really resulted to a margin expansion from 11% to 14.6%. So that's significantly above consensus. And as mentioned, it was really the strong pricing driving the growth. And this is despite the higher unit cost that they incurred in China, in Shanghai, driven by the shutdowns. And also in this period, those negative effect currencies and Bitcoin impairment. So we were holding quite a lot of amount of Bitcoins in cash, and due to weak cash flow generation in this quarter, they were forced to sell some of the Bitcoin. They did it at a massive discount, hence the impairment. And just looking at free cash flow in this period, it was roughly flat. It was at 0.6 billion, roughly flat from the previous period. And Tesla was forced to convert 75% of the Bitcoins. So really, the strong pricing was the driver of our increase in our earnings in this period. And in terms of our valuation, again, we still look at a differentiated business model, given Tesla's differentiated business model. So we look at EV luxury automakers, disruptive or software companies, and clean tech to sort of derive our multiple. So nothing changed in our multiple. We still exited at 30 times. Probably like to also point out, since Tesla doesn't have a direct peer, in the sense that other electric vehicle makers only start to earn profits around 2023 onwards. There's no direct peer group, and we think there'll be more competition coming through. And it's really hard to pinpoint the sustainable growth rate moving forward. So those definitely pose a risk, and our derived multiple still remains unchanged at 30 times. And we upgraded our earnings outlook for Tesla. So our base case now, looking at Tesla growing roughly about 23.5%. In a bull case, was slightly higher at 33%, and a bear case around 16%. So our exit multiples remain unchanged, and then and also our probability weighting remains. So we're really confident on our base case with roughly around 50%. Comes in at about a 33% discount to the share price. And we have a 50% weighting, and roughly the same on the bear and the bull case, and come to an intrinsic value about $633 per share, which represent about 22% downside on Tesla. And that's probably how we're thinking. That's how we're thinking about our valuations for Tesla, and nothing has changed aside from our pricing and our pricing revision. For the company, nothing much has changed in our valuation, so our recommendation is still a sell. Just probably a key takeaways on Tesla following these results. We still think it's a highly innovative company, which we try to reflect in our multiple, given the peer group, but we think it's highly overvalued and really appreciated by the market. The results came in quite strong, ahead of expectations, and we sort of pointed out the risk just in the previous slide. We upgraded our intrinsic value from 547 to $634 per share, and that's a back of strong pricing, resilient volume, maintain our exit multiple, and our recommendation is still sell, which remains unchanged. Thank you.